Very good afternoon, good morning. Welcome to HYCM's Leveling Up workshop with myself, Giles Coughlin, Chief Currency Analyst. Very warm welcome to you. I'm glad you could make it today. Jabin, Josh, John, Super, Warren, good to see you. Good to have you here. Just as other folks are coming into the webinar, just quickly go through the explanation that this webinar is not designed to be looking at trading advice or how to trade or what instrument to be trading when. The whole idea of this is you look over my shoulder, someone with a professional trading background, and you see how I analyze the markets, and those skills you can sort of pick up over time, as many people have done and are doing as they follow to these webinars. Basically, it's just not a signal trading service. Okay, so remember, when we're trading, the key concepts that I teach in this workshop that I've managed to really filter down is to this very, very simple concept is you always look to back weakness against strength. Okay, always look to back weakness against strength. Just as you'd expect to see this strong arm in this presentation beat the relatively weaker arm, in the same way that we back strength against weakness if we were trying to guess which arm would overpower the other one, we are always looking to pair a strong currency against a weak currency when we're trading currency markets. Now, I want to just go over to the other screen, and I want to share with you a checklist. Now, in this checklist, I want to give you a little bit of a heads up in trading a checklist. Now, if you have a look at this, now take a screenshot of this checklist, but this is a checklist that I use in my trading. Okay, and I use this checklist in my trading to try to systemize the trades I take. Now, when you're making a checklist, there's two different errors you can fall into. The first error is you can make it too short, so it's not useful. The second error you can make is it's too long, so it's impractical. So this trading checklist that I use has the benefit that it is short enough to be usable, but long enough to be meaningful. And all you simply do is I go through the 1 to 5 scoring for each of these questions. And all in all, I'm looking for a score over 20 in order to take a trade. So, is there a strong fundamental story? That's looking at the strong versus the weak currency, yeah? Are there some strong technicals in place to manage the trade? Then I look at that. Is there any upcoming risk events that could impact the trade? You look at that. Is current sentiment a reason not to take the trade? Look at that. And then you look, do you have a good feel for the trade? Now, by having a gut feel section in this, it allows for your personal gut feel, but also it helps you not rely on your gut feel if your gut feel is not reliable. So sometimes, for instance, your gut feel might let you down. I was explaining this to another group of traders recently, and I was explaining that sometimes my gut feel for a trade is bad, even though everything else is lining up. And someone pointed out to me, well, that could just be risk aversion. So sometimes your gut feel could be something as simple as risk aversion that is actually hindering you from taking a really good trade. So I'll take an example of a trade that we'll look at today, okay? And we'll see how we can use that. But take a screenshot of that. It's a very helpful, short, easy checklist, and then I'll show you, how that can be used in our trading. Now, first thing for us to be looking at is the latest data that we've just had released from the UK Cpi data. Now, this was the best opportunity of the trading week. And what we were looking for is we were looking for inflation to miss expectations. Now, minimum expectations were 2.8% for the CPI year on year. And if we got a reading below 2.8%, that would have been a great opportunity to sell the pound. Why? Because over the last few weeks, the pound is being bought on inflationary fears. Bank of England's Governor Bailey, Bank of England Saunders have both expressed their concern about rising inflation in the UK and how that will mean the Bank of England will have to raise interest rates more quickly. And if you take a look at SONIA futures, what you'll see very, very clearly is that those SONIA futures have been moving sharply lower in expectation of rising interest rates. Can you see the way the SONIA futures are moving? Now, the way this works is the different colors represent different contracts. So the M contract is June, the U contract is September next year, the Z contract is 2022 next year, this Z contract is the end of 2021. So you can see what this means. The current interest rate of the Bank of England is 0.10%. So SONIA futures are 99.48. So what you do is you take 100, take away 0.10, the current interest rate, so that leaves us 99.90, and that means that there is from 90 to 50 about a 40 basis points move. So what that means is markets are expecting an interest rate hike before the end of this year and 4 interest rate hikes next year. That doesn't seem right, does it? That's a very, very aggressive rate path. So with such an aggressive, yeah, you're welcome, Jabin. See, with such an aggressive rate path, what that means is the pound has been heavily bid over the last number of sessions, right? Because traders are expecting harder and faster interest rate hikes. So now you got to put your thinking cap on, right? So that means inflation, if inflation is a concern, if inflation ends up not being a concern, then those markets can revert to their mean. So the inflation reading today was a miss, and that is good news for pound selling. Now, I was looking for a print of 2.8%. If I got 2.8%, I would have jumped in to euro pound longs. Now, if you just look at it, and we look at the actual data that came out, we can see that this was where the inflation came from. So the deflationary forces came from restaurants and hotels. Now in the UK, there was a scheme called Eat Out to help out. It was basically a scheme where people who went to restaurants in the UK only had to pay 50% of the bill. The other 50% of the bill was paid by the UK government. It was a way of helping people during COVID-19 visit their local restaurants and pubs and support them. So with that scheme ending, it meant that base effects have meant that, comparatively speaking, restaurants are cheaper. Now, it's not that they're cheaper, it's just the fact that when they were doing the Eat Out to Help Out scheme, people weren't using 2-for-1 vouchers, they weren't using discount codes, and people were paying the full menu price, and the government was paying the other 50% of the full menu price, right? So that 50% discount was being offset by the government, so prices were higher. Now the scheme's ended, then prices have dropped to reflect the more normal market conditions. So you can see here in the inflationary detail, what does that mean? Well, it means that look at the other things, they are rising. Food, alcohol, housing, furniture, transport, recreation, culture, education, communication, health margin, everything apart from clothing and footwear, prices are going up. So once those base effects fade, then what does it tell you? Inflation is rising in the UK. Right? Now, look at the household savings. Now, household savings are still quite high in the United Kingdom. So that's good news because it tells us that UK households are going to be able to pay for some of those rising inflationary forces. So all in all, that tells you that inflation was not quite as bad as feared, but there's still inflationary pressure in the system. So that isn't a great and obviously tradable opportunity out of market prices. But nevertheless, what we can see is that the euro pound has moved a little bit higher. So let's just go and have a look at the euro pound, and we can see out of the event that the euro pound has moved just a touch higher out of the event, but we've moved up to that R1 and we've found a little bit of resistance. Okay, so looking at that, yes, the inflation was a miss, so we saw a bit of relief in the pound selling. Looking at the SONIA futures, we can see that the SONIA futures, look, they've retraced a little bit higher today, haven't they? Just that little tick up, tick up, tick up, tick up. So rate traders are a little less concerned, but it's not enough to fundamentally change things. But what it would mean is if we got any retracements lower today, it wouldn't be unreasonable to take a long from that pivot point. It's a little bit more speculative, but what you can see here is that with inflation being a slight disappointment, there is pressure for euro pound upside. Okay, there's pressure for euro pound upside. And if the dollar's being a bit stronger today, you just have a look at the majors, see the dollar. If the dollar can find a little bit of strength, that will pressure the euro-US dollar a little bit lower as well. So when we're putting these things together, we're putting these different factors together, what we can see is we want to be pairing that strength against that weakness. Now, that is not a really obvious tradable opportunity. It's not a high conviction trade. It's a little short-term trade, but ideally we want those high conviction, really obvious trades to be taken. Now, we've also just had Canadian CPI data. Now, if you go out onto my blog, you can see my blog here, my blog's hycmlab.com. I've got a whole host of brilliant articles there. So even if I do say so myself, forgive me, but if you're learning to trade, you really, really want to go there. And that blog, you could put, I've got loads of different sections. But one of the most helpful sections is Central Bank Watch. And in that, I look at what the latest central bank meetings and decisions have been. And here, I look at the major central bank rundown, try to do it once a month, once every 6 weeks. I look at what the central banks are doing. And see, the Bank of Canada, at their last meeting, they held rates at 0.25%, and they see lifting rates around the second half of 2022, okay? So what we know now is helpful. We know that the Bank of Canada, they're holding rates at lifting rates second half of 2022. Now, we had inflation just out, and the inflation details just been released, and we can see that the Canada's favored inflation metric is the trim, the core, and the median. So the core and the trim and the median, these aspects here. And you can see trim's a bit higher, median's a little bit higher, and the core is a little bit higher. So all of Canada's slightly higher readings, year-on-year core higher as well. Now that is supportive of CAD. So that should result in something like CAD upside when you have inflation moving higher, because this will start to raise expectations that we're going to see the Bank of Canada maybe become more aggressive on their interest rate schedules. So typically what you'd expect to see is US dollar CAD weakness in that kind of environment. So with CAD being a bit weaker, US dollar being a bit weaker, CAD being a bit stronger, we see that the US dollar CAD sold off. Now, it's moving higher now because there isn't anything massively significant here, okay? Inflation's a bit higher, yeah, that's pretty much as expected. Is it going to change what the Bank of Canada does next week? Probably not, because the Bank of Canada are meeting next week. But it does show us what that bias is, which is higher inflation means interest rates are more likely to rise, which means the CAD should strengthen. So we want to look at, maybe if we look at Canada yields, you can see that yields are moving lower across the board today, and yields are still pressured to the downside. So there isn't a major yield impact from that data print. So all it does is it just tells us that, yeah, inflation is higher, but that's pretty much as expected. But we just bear that in mind, okay? The print wasn't massively above expectations, and the big surprise here would have been if the inflation was a miss. Just like with the euro pound, seeing a miss in inflation had more impact than just seeing higher inflation, because everyone's expecting higher inflation at the moment. So let's now take a little look through markets and let's see what's going on. We've covered some of the major events. So looking at SONIA futures, we can see them pushing lower. Looking at the majors, we can see that the US dollar has been weaker on the session. Now, a weaker dollar lifts the majors, right? We can also see dollar yen moving lower. Now, remember, the dollar yen moves lower with the 10-year yields pushing lower. So as yields push lower, then we're also seeing downside in the US dollar yen, which is what we'd expect. And that weakness in the yen will also give weakness to yen crosses. So if we take a look at the yen crosses, see a little bit of weakness across the board in the yen crosses, and CAD yen seeing a little bit of weakness. Aussie yen, New Zealand dollar yen, still positive on the day, but just pulling back from the higher levels. So remember that 10-year yields has a big impact on the yen. This is the US 10-year yield chart on the dollar yen, and you can see that, you see how price tracks it carefully? As yields move lower, the dollar yen is moving lower, but the medium-term bias for the US dollar yen is to the upside. Now, you might say, why will the yen pairs weakened? Well, it's been for a very obvious reason, and it's this. And it'll become obvious when I show you all the bond markets. Now, this is the bond markets on the weekly chart, right? Now, what do you notice? You can see that yields are moving higher across the board, but not in Japan. Now, why are yields moving higher across the board? It's because of this. Investors are expecting high inflation to mean central banks around the world raise interest rates to address the high inflation. The only way, really, that a central bank can address inflation is by hiking interest rates. So as inflation readings have been coming in high, and we've just seen a high reading out for Canada, yields have been going up across the board as investors expect central banks to raise interest rates, but not in Japan. Why not in Japan? It's because Japan are using what's called yield curve control. And what yield curve control means is they won't allow the 10-year Japanese bond to move above 0.10. They are actively entering the market so that the yield does not push above 0.10. That means there's a massive yield differential between the major pairs. So if I let's take a look at this. Let's take a look at something like New Zealand dollar yen. Okay. Oh no, we'll look at CAD yen. Okay. So let's compare the two. So let's take a bond yield spread of Canada 10-year bonds, and let's minus from it Japanese 10-year bond. Okay. So now we've got the Canadian 10-year bond. Take away the Japanese 10-year bond. That's called the yield spread. That is now on the chart. We'll just get rid of we'll just get rid of that. Right, and you can see here. Right, do you see how price tracks that yield spread? That is the bond yield spread between the Bank of Canada and the Bank of Japan. As the bond yield spread rises, the CAD yen pair rises. As the bond yield spread falls, look, the CAD yen pairs falls. And look, lo and behold, with this bond yield spread moving higher, and to see how helpful this was, right? You see, look, when this bond yield spread broke higher, right? Look at that. The bond yield spread broke higher, and that breakout was on like the 15th of September 2021. Now, if you take a look at the CAD yen chart, you can see that actually, look, the bond yield spread broke 15th September, but the trend line of the actual CAD yen price didn't break higher till 24th of September. So you see how that bond yield spread that break would have given you a 10-day heads up, right? And you can see how you got that bond yield spread divergence in 22nd of September. The bond yield spread trending higher, CAD yen trending lower, right? That's a big divergence. And then you get the wicked whip higher as oil prices shot up. So you see, this is the power of the bond yield spread. Now, do you see why yen pairs are so weak? Do you understand that? It's all to do with the yields. Now, FX traders look at bond markets for the simple reason. Bond markets look at interest rates. And when interest rates are rising, a currency strengthening. When interest rates are falling, a currency is weakening. That's why FX traders look at bond markets. And over time, you can trade these bond markets yourself, right? You can just trade the bond. It can be as simple as that. So understanding that key point is really crucial. Okay. Now, a couple of interesting places. Again, this is the trade I'm in, right? And it's a bit more speculative, but I'll just run it through with you. So see here, we have a Harami inside bar pattern up against that trend line. Now I'm looking for price to move up higher through here. So I've entered on a break of 15.53.1. Okay, so I'm long there. I've just got my stop running below 15.40. Okay. Now this is a Harami inside bar pattern. If the inside bar breaks, you typically expect that to hold. So I'm looking for a break to the upside of that trend line, looking for potential retest to 15,700. Now, medium term, the outlook is broadly supportive for DAX. Looking at the seasonals for the DAX, you can see that, look, between now and the 31st of December, the last 10 years, the DAX has gained 8 of those 10 times, maximum 12.01% move higher in the DAX, right? So I've got a bias from a seasonal perspective. The reason this tends to work is because of fund inflows around this time of the year. That's not the reason solely for taking the trade, it's just a supportive reason. Also, look at the volatility index. Now, this volatility index here, let me show you, right? This is called the VIX. And the VIX is the volatility index of the S&P 500 options market. And what this does, if you notice, when the VIX rises, the blue line's the S&P 500, the S&P 500 falls. Rising VIX, falling S&P 500, rising VIX, falling S&P 500, rising VIX, you get it. Falling VIX, rising stocks, falling VIX, rising stocks. So with the VIX falling, I'm anticipating that to be supportive of stocks today. Now, against my outlook is the fact that, look, we're heading into this heavy support level. So we wouldn't be that surprised to see a spike. So it is more speculative, my trade, but the technicals are very good. I can just tightly keep my stops below. And usually if these Harami inside bar patterns work, they tend to be quite aggressive and it's quite an obvious place to enter. The other thing that's against my trade is that the S&P 500 Dow are right slap bang up at that overhead resistance level. So not a great place to go long. We've also got FTSE 100. Now I'm waiting for that FTSE 100 to fill this COVID-19 gap. That was pre-COVID-19 levels, and you can see that that area has fallen in all the major global indices. You can see that that COVID-19 gap in the S&P 500. You just see, where was it? It was like here. You see how much the S&P 500 has taken that on. Look at the look at the Dow. The COVID gap filled, right? So I'm looking now, the FTSE 100, is that going to fill the COVID-19 gap? I hope to, which will mean a potential upside here in the FTSE 100. If, a clean break of like 7225 with stops below 7175, and then you can just trail the stop below the latest high. So I think that would be a nice little entry. Just break 7227. Stops can be placed safely below 7177. the safer place would be below that trend line. If price revolves back down, then the other place to enter would be entering at 7,150, stops below like 7,100, and then looking for a bounce back up towards 7,500. Keep your eye on the VIX. If the VIX keeps pushing lower, that should be supportive of stocks higher. Okay, but generally speaking, you know, the medium-term situation for stocks still makes sense. Interest rates are low, fiscal stimulus abounds. There's still potential for upside. If that VIX starts rising, and what you want to look for is if the VIX starts sort of getting into and above 18, then you know that that's probably going to be stopping you out of the trade anyway. All right, so keep your eye on that going forward. Now, in terms of, let's now use an example of the New Zealand dollar Japanese yen pair. Okay, so we'll take a look at the New Zealand dollar Japanese yen pair, and we'll look at this to organize a swing trade, right? So we've got the RBNZ. They're expected to hike interest rates 4 times next year. Bank of Japan, we just mentioned they're on yield curve control and not expected to raise interest rates. So there is a strong interest rate differential between the RBNZ and the Bank of Japan. We can see the bond yield spread here. If you look at the bond yield spread, you can see that the bond yield spread is pushing higher, okay? Sharply above that trend line on the interest rate differential. So therefore, we have a strong bias to buy the New Zealand dollar Japanese yen pair, right? Now, is it good to get in here? No, it's a bad area. We're right into this key overhead technical resistance area, okay? You see? So remember what we're trying to do here. We are trying to pair weakness against strength, okay? So go back to the main screen. You can see here, right? Here's the main screen, weakness against strength. Here we have an example, weakness against strength. Now, is it good technically to enter there? No, it's overhead resistance. You don't buy into resistance, okay? You buy from support. So this is a great place to take profit for people who are long New Zealand dollar Japanese yen, but it's not the right place to enter. You want to enter on a swing trade back. Now, I've done a Fibonacci retracement on the chart. See, you draw it from the left to the right, and here we have the 50% Fibonacci retracement level, which is also, it's just the large weekly trend line going all the way back to 2015. You can see we had 1 touch, 2 touch, 3 touch trend lines valid. Retracement back down to that level is ideal for going long, and we're looking at anywhere in that 79.50, 80 region is now suitable for going long. We take tops there of that level, and anywhere in that region is suitable for going long. You know, around it's basically the 80 region we want to look for. Okay, around that 80 region. So that means any retracements back down to 80 can be suitable for buying. All right, now let's look and use our trading checklist as an example. So we're going to take the RBNZ and the Bank of Japan. Okay, so question 1, is there a strong fundamental story for the trade? Yes, it's 5 out of 5. Bank of Japan not hiking for the foreseeable future. RBNZ hiking 4 times next year. What did the New Zealand see this week at the start of the week? Some of the highest inflation in 10 years. So there's strong New Zealand dollar strength. Are there strong technicals in place to manage the trade? Yes. 50% fib, descending trend line, 5 out of 5. Is there any upcoming risk events that could impact the trade? Yes. There's the Bank of Japan that's meeting next week. So that has the potential to impact the trade, particularly given how much weakness there has been in the yen. So there is a slight risk. They show some concern about the weakness of the yen. So we're going to give that 4 out of 5. is current sentiment a reason not to take the trade? No, there's no specific mood today that means we shouldn't take the trade. The kind of sentiment that means we shouldn't take the trade would be if there was a massive risk off selling. If there was a big issue, Evergrande collapse or some huge issue, then that would give us enough reason not to take the trade. Do you have a good feel for the trade? Well, yes, I do. So it will be 5 out of 5. So if we added that all together, we'd say 5, 10, 14, 19, 24. So we would go New Zealand dollar, Japanese yen. We have a 24 score, and then we just have the outcome. And then maybe you put your orders in, and maybe you come back to it next week after the Bank of Japan has met, and you're thinking to yourself, ooh, why am I long the New Zealand dollar, Japanese yen? Well, you just go through the same process. You know, is there a strong fundamental, and you score it again. And as long as your score's above 20, you can stay with the trade. So there is a very good example of how to do that. If you haven't taken a screenshot of that, take a screenshot and use it for yourself, okay? Now, that's what we're doing. When we're trading FX, we're trading strength against weakness. And if you're trading that way, you find that you're going to get out of losing trades much quicker. You're going to find yourself catching larger moves, and you're going to have a better sense of security because you know why trades are moving in the direction they should be moving in. Don't forget, every week, every Monday, we look at the next coming week. I'll be getting ready next week for Bank of Canada meeting, their interest rate decision. Bank of Japan and the European Central Bank are all meeting next week. So be sure to get my live market analysis look ahead on Monday, and we'll dig into some of that detail. Hope that helps, folks. It's been a pleasure as always. Just going to look at the questions. So if you've got any questions, please do type them now in the chat box or the question box. Don't forget, you can follow me on Twitter. Thank you for those who do. Thank you for the likes. Thank you for your contact there, Warren. Always appreciated. And my Twitter handle is @GilesCoughlanCCA. I'll just put that into the box, and I try to put some helpful posts up there and helpful charts, and just try to keep, try to keep things generally helpful on my Twitter feed. So do come along to that, and I do draw us attention to relevant market points that I think are helpful. Warren says we can use that interest rate differential as a theme also in the trade. Yes, absolutely. The interest rate differential is a great way of finding that strength against weakness, particularly when you see a divergence between the two. When you see the bond yield spread moving one way and price moving another, that can be a really good opportunity. And I use that for a trade I took this week in the Aussie New Zealand dollar, and I'll just see if I've got it on my chart still. I'll show you how I use that. Yeah, I took a short in the Aussie New Zealand dollar. Basically, longer term, basically the Aussie New Zealand will be sold off very heavily, okay? Because RBA not hiking till 2024, RBNZ hiking 4 times next year. Now that story's been coming out slowly, and those of us who've been attending this webinar, et cetera, we've been talking about that for weeks. And I shorted that into these positions. I think I took profit down at that level with a short when we had a bit of a move, right? Now the Aussie retraced just simply because of natural retracement. So much short, there was so much short positioning in the Aussie, it was worth the retracement. Now, what got me back into the trade was that, look, the fundamentals are still downside. Nothing's changed. It's still RBA not hiking until 2024, RBNZ hiking 4 times next year. So sellers on rallies, right? So we had the rally. Now, when price moved up to that 200 exponential moving average, that was significant. And then for me, the entry was just a simple break of the trend line. So the simple trend line break on the 4-hour chart, I entered into the break and I took profit as price faffed around this 200 exponential moving average. So it was over here. I think price moved up to about 1.0470 and I took profit. I entered in around 1.0530. So you nearly got 100 points on the move, right? And it was just a simple move because I was expecting further downside. Here we go. The bond yield spread was flagging the way, and you see the bond yield spread was giving you a little bit of a heads up. And again, you can see, look, the bond yield spread, and you see that the yield spread broke before price did again, right? That just a very helpful little tool. So, getting into this detail, drumming down into it is important. Yeah, what's your take on Aussie CAD? Right, let's have a look at it. So first of all, Aussie CAD has a medium-term sell bias for sure. RBA not expected to hike interest rates till 2024. But look at this. This is the thing I want to show you, Warren. If you look how heavily sold the Aussie dollar is. So yes, I'm bearish the Aussie dollar, and I am, but I'm expecting a retracement in the Aussie dollar because look, do you see how heavily sold, hold short the Aussie is? Look at the last COP report. Large speculators have a record short Aussie dollar position. Now, the reason, whenever you're trading the Aussie dollar, you need to look at a couple of commodities. So first of all, you need to look at iron ore prices, and then you also need to look at coal prices, okay? Now, iron ore prices have been dropping. That's a negative for the Aussie dollar. That's one of the things that's been weighing on the Aussie dollar. RBA not hiking until 2024. Iron ore prices collapsing with steel mill production dropping off in China. We've seen COVID-19 lockdowns grow in Australia over the last few weeks, right? Yada, yada, yada. All of that was weakness against the Aussie, and I was buying the pound against the Aussie from like July, I think it was. Took a nice, lovely long trade on this theme, right? So, people like me have been selling the Aussie dollar for a while. And now it's a bit overstretched. You understand the concept, right? So getting a little bit of a retracement in the Australian dollar makes sense. Now the CAD has been heavily supported. What on? Rising oil. Whenever you're trading CAD, you always need to have an idea of what's happening with oil markets. And oil markets have been an absolute ripper, pushing through that 77 region and heavily supported. So that's been supporting the CAD. So the Aussie CAD pair is a medium-term sell bias pair. And if we just take a look at this on the 1 day, you just see that strong selling pressure has been on. Now the Aussie is moving higher, just in a little bit of retracement. Now my view with the RBA is the worst is now behind them. If you go to my blog, Warren, you'll see the last central bank meeting from the RBA was 6th of October, which I covered at the start of this month. On track for recovery, right? So what you got, I talk about here, what's dragging on the Aussie, talk about that, very heavily short Aussie position. But this is the thing that struck me. You sense that there were core, maximum pessimism has been reached, right? So we were looking for some kind of mean reversion, some retracement back. Like we've been seeing that, okay? So that was the bottom line is the RBA started to look at picking themselves back up into next year. It would make sense to start seeing some of these large Aussie short positions unwind. It's not that the Aussie is bullish, but shorts look stretched now, and the latest RBA meeting has confirmed that. The first major support level for Aussie yen is here on the weekly chart. So I was looking at this and thinking, oh, that looks tasty for a long, right? And that was when the Aussie yen was about 80.66. And then if we just have a quick butchers at the Aussie yen, now we can see on the weekly chart that, look, price has moved from 80.66 and is now right up at 85, right? So that's been a long way, but it's been necessary to say it, right? That's supporting the Aussie. Now the CAD has been strong on this oil strength. Now oil has been running stronger and stronger and is due a bit of a retracement. So I'm expecting sellers once we hit a major level, and the major level for me will be on this probable trend line here, 1, 2, 3, just into that 200 exponential moving average. I'd be expecting sellers at 0.9300, this region here. And then I'd want to see how things play out. How's iron ore prices do? How's China's growth doing? What's oil prices doing? And if the current status quo was still in play, then I'd favour Aussie CAD shorts. I don't have enough conviction in it, Warren, to start saying, well, I'm gonna trade this back up to there. I don't see that. You know, a break of that trend line, yeah, maybe a little bit of speculation, maybe, but I wouldn't have done because CAD has reasons for strength, and the Bank of Canada is meeting next week. So they could change their rate path. Remember, we looked at the rate path they're on, hiking middle of next year, 2022. Now, the better pairs, I'd say, Warren, is Aussie yen long, CAD yen long. Both of them make sense to me on pullbacks. The problem I've got with Aussie CAD is you've got CAD, which is stronger, and the Australian dollar has been peak bearishness and is finding a little bit of a reprieve. Quite tricky to, get your timing on that. Do you know what I mean? So it's just pick your levels. For me, move back up there, keep your stops above the 200 exponential moving average. Look for a sell back down to 0.9150, something like that would make sense to me, Warren. Can you see the rationale for that? Oh, can't see the charts. I hate this go-to webinar control panel. It's so easy to do that. It's so easy to do that, right? Ah, dear. My big apologies. Right. So basically, you can see it here. I hope the information at least came over. My apologies for that. Warren, I'm so sorry. It's the way this go-to webinar control panel does. It's such an easy mistake to make. I'm sorry you've had to suffer it. Right. So if it moves back up to here, that's why I've been looking at shorting it again. But if China picks up, and look at this market in particular, if iron ore prices pick up, right, higher, that will be a little bit of bullishness for the Australian dollar. So the Australian dollar could easily correct quite significantly, and it is doing. And this is what I was showing you here with the, the latest RBA meeting has confirmed that there's a more bullish outlook for the Australian dollar, not because it's bullish, but because shorts look stretched, right? Massive stretch shorts. See that really short stretch? Looking at the Aussie yen. I was looking at the Aussie yen, it's that 80.66 region, and you can see like Aussie yen now, look, it's moved up to the 85.86 region, right? So that was my take on it, Warren, back in like 6th of October, and my view hasn't changed. Got that same outlook. But this retracement in the Aussie is like a retracement from stretch shorts. It's not a bullishness, if that makes sense. Yeah, great. That's what I've been looking at. I've been looking at that there. But as I said, like the better opportunities is something like the New Zealand dollar yen. And as a general rule, you want to be focusing on those sort of, easier opportunities. Because do you see how like something like this, Warren, like that's so much easier, that's so much less stress, right? RBNZ hiking like 4 times next year, Bank of Japan expected to stay still forever, People will be saying, is the carry trade back? Well, it might be, right? So that's a much simpler trade. Okay, folks. Right, apologies for getting the screens mixed up. I'm sorry I had to suffer that, it's very annoying. Monday, I'll be getting ready for the central bank meeting, so make sure you come along. Thank you all for attending, I do appreciate Thank you for your support. Yeah, thanks. Yeah, good. Excellent. I know you understand it, Warren. It's just helpful to go through it, and thank you for bringing up the example. And you know, anytime anyone's got a pair they want me to look at, just look at it and we can talk it through together. Do use that sheet that I've given you. That'll just help. Right? Take it away, use it. It'll help your decision making. It's amazing what a checklist can do. Pilots use it for a reason. You know. Yes, pilots are very skilled, but they still use a checklist just so they don't forget anything. Okay, folks, take care and really enjoy the rest of your session. Look forward to seeing you guys on Monday. Thank you now. Goodbye.